While most people were glued to their screens watching frozen charts and disabled buy buttons, something far more important was happening far away from the noise of the trading floor. Markets were halted, margins were raised, volatility was blamed. But the real story was not on your screen, it was on the loading dock. History rarely announces itself with flashing headlines. It moves quietly through warehouses, ports, and vaults while attention is diverted elsewhere. As traders argued online about manipulation and unfair rules, physical metal was leaving Western vaults at an unprecedented scale. Not slowly, not cautiously. It was moving with urgency. In just 48 hours, the volume of precious metals shipped out of key logistical hubs eclipsed anything seen in generations. This was not retail demand. This was not speculation. This was a strategic evacuation of real assets from a system that no longer works. The vaults didn't misplace the metal. It wasn't consumed. It migrated from New York, from London, from the heart of the Western financial system. And it moved toward a buyer that understands one rule better than anyone else: paper promises fail, but physical control endures. While you were locked out of trade, someone else was quietly taking delivery. This is how modern financial collapses begin, not with a crash, but with absence. The shelves look full on paper, but the warehouse is empty. Prices still flash on screens, yet the goods are already gone. The market tells you everything is fine right up until the moment delivery matters. And then the illusion breaks. What makes this moment dangerous is not volatility, it's certainty. Certainty that the gap between paper price and physical reality has grown too wide to hide. Certainty that someone has decided the risk is no longer worth carrying. And certainty that once physical assets leave a system under stress, they rarely come back. This chapter is not about panic, it's about awareness, because by the time the headlines catch up, the opportunity to act is already gone. If you want to understand where markets are really headed, you must stop watching the screen and start following the metal. That trail leads to a conclusion most people are not prepared for. If this perspective adds value, subscribe to the channel and comment. 1, if you're watching closely, or 2, if you think the market still has everything under control. To understand why this movement of metal matters, you must stop thinking like a trader and start thinking like a systems analyst. Markets do not collapse because prices fluctuate. They collapse when trust in delivery disappears, and that trust vanishes the moment physical settlement becomes optional rather than guaranteed. For decades, the precious metals market survived on an assumption most participants would never ask for the real thing. Contracts were rolled forward, positions were netted out, the same bars were leased rehypothecated and counted multiple times. On paper, everything balanced. In reality, the system depended on one fragile condition: compliance. As long as no one demanded delivery, the illusion held. That condition has now failed. What triggered the rupture was not emotion or ideology, but pure mathematics. When identical metal trades at dramatically different prices in different locations, arbitrage takes over. An 18% premium is not a market signal, it is a command. It tells every refinery and logistics firm exactly where value is real and immediate. Metal does not debate, it moves. No producer sells below market out of loyalty. No vault holds inventory out of sentiment. Assets flow towards certainty, speed, and physical settlement. When one system offers cash promises and another demands immediate delivery, the outcome is predetermined. The metal leaves. And it leaves fast. This did not unfold over years. It happened in days. That speed tells us something uncomfortable: the supply was already gone. The arbitrage window didn't drain the market. It exposed it. Once opened, it acted like gravity, pulling every uncommitted ounce through. Here is the critical mistake most observers make. They expect price to reveal scarcity. Historically, it never does. Scarcity appears first as unavailability, then as rising premiums, and only later as price spikes. By the time charts react, the physical market has already moved on. This is not about panic. It is about mechanics. And mechanically, this system has crossed a threshold it cannot reverse. Once physical supply starts to disappear, the paper structure above it becomes unstable by definition. This is where the difference between exposure and ownership stops being theoretical. A contract gives you price exposure. Physical metal gives you control. In calm markets, that distinction feels abstract. In stressed systems, it becomes decisive. Inventory reports appear reassuring at first glance. Ounces are listed, vaults are named. Categories look orderly. But most of that metal is not available. It is privately owned, leased, or already promised. What remains for actual delivery is a thin layer supporting an enormous stack of claims. When claims vastly outnumber deliverable supply, the market ceases to function normally. It becomes a queue. And queues expose reality. Early participants receive metal. Everyone else receives alternatives, cash settlements, delays, explanations. This is not fraud by design. It is the inevitable outcome of fractional systems under stress. The danger lies in ratios. When hundreds of paper claims sit on each remaining deliverable ounce, the system depends on a single behavior compliance. As long as holders accept rollovers, it survives. The moment they demand delivery, the math fails instantly. This is why officials avoid the word default. They prefer softer language, extraordinary conditions, temporary adjustments. But if metal cannot be delivered, the promise is already broken. The settlement method only determines who absorbs the loss. At this stage, behavior shifts rapidly. Scarcity creates urgency. Urgency accelerates withdrawal. Each ounce removed increases pressure on what remains. This feedback loop does not stabilize. It compounds. Once trust in delivery erodes, it does not quietly return. Paper instruments don't disappear. They simply lose relevance. The market continues trading, but the meaning changes. Markets rarely collapse overnight. They empty first. And by the time the structure visibly fails, the outcome has already been decided. At this point, the question is no longer whether the system is stressed, but why certain players are willing to absorb so much physical supply at once. This is not a speculative trade chasing momentum. It is strategic behavior driven by long-term necessity. When an actor prioritizes possession over price, they are preparing for a future where access matters more than valuation. Industrial economies do not function on contracts. They function on inputs. Energy systems, advanced manufacturing, communications, infrastructure, and defense production all rely on materials that cannot be substituted at scale. Silver is one of those materials. It is not a luxury. It is an enabler. Without it, entire supply chains slow, then stop. This is why the current accumulation is not price-sensitive. When survival sovereignty or strategic independence is at stake, the purchase decision changes. The question is no longer, is this cheap? It becomes, can we get it at all? That shift transforms a market. Sellers disappear. Inventory becomes insurance. And those without stock are forced into dependence. History offers a clear pattern. Nations that anticipate scarcity accumulate quietly. They do not announce intentions. They exploit periods of suppressed pricing and excess confidence. By the time shortages are publicly acknowledged, the stockpiles are already built. The visible phase always comes last. What makes this episode different is transparency after the fact. The data is beginning to surface, and it contradicts years of reassuring narratives. Production is declining, demand is structural, recycling cannot close the gap. And once metal enters certain jurisdictions, it does not return to global circulation. It is consumed, embedded, or locked away. This is why the idea of a quick rebalancing is dangerous. There is no surge of hidden supply waiting to rescue the market. There is only a shrinking pool of available material and a growing list of users who cannot function without it. When those users compete, price becomes secondary to continuity. This is the moment when markets stop being financial abstractions and return to their physical roots. The system no longer asks who is right. It asks who is prepared. Once strategic actors lock in supply, the impact spreads far beyond financial markets. Policy goals collide with physical limits, ambitions meet constraints, and carefully designed plans begin to fail for reasons no regulation can fix. This is where ideology runs into material reality. Modern industrial systems are metal-intensive by nature. Energy infrastructure, electric transportation, data networks, and advanced manufacturing all rely on conductive materials at scale. Silver plays a central role in that equation. It cannot be efficiently replaced, and efficiency gains cannot remove the need for it. When supply tightens, timelines break. This creates a structural contradiction. Governments commit to targets that assume abundant inputs while operating in a world where those inputs are no longer freely available. When materials become scarce or unpredictable, projects stall. Factories slow. Forecasts are quietly revised downward. Shortages do not arrive as headlines. They appear as delays, back orders, and canceled allocations. Manufacturers blame logistics. Officials cite temporary disruptions. But the cause is simpler. The material is not available in sufficient quantity. This is where price signals lose meaning. Screen prices imply liquidity. The real market communicates scarcity through premiums, rationing, and refusal to sell. The gap widens until official prices become symbolic, while actual transactions happen elsewhere. Once industrial users recognize this, behavior shifts abruptly. Just-in-time systems give way to precautionary stockpiling. Survival replaces efficiency. That single change is enough to overwhelm what little supply remains. No policy can conjure metal overnight. Mining, refining, and substitution take years. When inventories are depleted, adjustment is slow and unforgiving. At this stage, the crisis is no longer financial, it is physical. And physical constraints do not negotiate. As physical constraints tighten, attention turns to accountability. How did a system this critical deteriorate without intervention? The answer is not a single mistake, but a pattern of incentives that favored short-term stability over long-term resilience. For years, suppressed prices were treated as policy, not risk. Keeping prices low served clear objectives. It muted visible inflation. It supported consumer confidence. It allowed governments to run deficits with less resistance. But every distorted price sends a signal. Producers invest less. Consumption increases. And foreign buyers recognize an opportunity to acquire resources cheaply. Over time, the imbalance compounds. Domestic stockpiles shrink. Strategic reserves are sold, leased, or quietly depleted. External demand accumulates patiently. By the time stress becomes visible, the inventory is already gone. What appears sudden is usually the final stage of long erosion. Regulatory frameworks struggle here because they assume normal behavior. Reports look acceptable. Ratios appear stable. Stress tests pass. But these tools fail when incentives change. When participants stop rolling contracts and demand delivery, the assumptions collapse. Institutions then shift from solutions to legal defenses. Clauses are invoked. Obligations are redefined. Cash settlement replaces fulfillment. On paper, order remains. In reality, trust is broken. If delivery must be avoided, the market's function is already lost. The public often focuses on legality rather than purpose. A contract may still exist, but its meaning changes when the underlying asset cannot be delivered. At that point, the instrument survives in form, not substance. This is not malice. It is deferred risk returning. Stability was purchased by postponement, and postponed risk always comes back concentrated and unforgiving. Once confidence erodes, it cannot be restored by regulation alone. Participants adapt, they exit, they hoard, and they stop trusting promises unsupported by real reserves. When confidence breaks inside a critical market, the damage never stays isolated. Stress spreads outward, first to related institutions, then to the broader financial system. What begins as a delivery issue quickly becomes a balance sheet problem, and balance sheet problems force action. Large financial institutions are deeply embedded in this structure. Many hold exposure through derivatives and short positions built on one assumption: continuous liquidity. When physical supply disappears, that assumption fails. Hedges stop working. Risk models lose relevance. Losses move from abstract to immediate. At this stage, the system faces a familiar choice: allow failures to cascade or intervene to preserve stability. History shows the same response almost every time. Liquidity is injected, losses are absorbed, the system survives, but the problem is deferred. That deferral carries a cost. New currency is created to stabilize institutions. Asset prices inflate. Purchasing power erodes. Stability is maintained by dilution. Each intervention transfers private risk onto the public balance sheet. What's different now is perception. Intervention no longer restores confidence. It accelerates the shift away from paper claims toward tangible assets. Participants understand the pattern. Bailouts protect systems, not value. Each cycle pushes capital toward what cannot be printed. As this realization spreads, behavior changes. Institutions shorten horizons. Corporations prioritize inventory over efficiency. Individuals seek assets with no counterparty risk. These responses are rational, but together they intensify scarcity. The feedback loop tightens. Intervention weakens currency. Weaker currency drives demand for real assets. Demand tightens supply. Tight supply increases stress. Attempts to stabilize one layer destabilize another. This is the phase where policy tools lose influence. Markets still function, but belief has moved. And once belief shifts, it does not quietly return. When scarcity becomes visible, it no longer remains confined to institutions and supply chains. It reaches the public. And when the public begins to sense that access is disappearing, behavior changes fast. This is not panic in the cinematic sense. It is rational acceleration. People move to secure what they can while they still can. Retail availability is always the last signal, but it is the one that matters most. Allocations are reduced. Backorders stretch. Premiums rise quietly at first, then abruptly. The quoted price still flashes on screens, but it becomes increasingly irrelevant. The real price is discovered in availability, not numbers. This is where the distinction between price and cost becomes unavoidable. Price is what is advertised. Cost is what must be paid to actually obtain the asset. When shelves empty, cost detaches from price. The spread tells the truth the chart cannot. As access tightens, trust in financial intermediaries weakens further. Claims accounts and representations lose appeal. What matters is possession. Assets that require permission settlement or counterparties are reassessed. The public may not articulate it in technical terms, but the behavior is clear. This shift feeds back into the system. Retail demand reinforces institutional hoarding. Premium signals scarcity upstream. Suppliers respond by rationing. The loop accelerates not because of fear, but because of logic. Once scarcity is recognized, delay becomes risk. At this stage, narratives attempt to regain control. Officials urge calm. Media frame shortages as temporary. But narratives do not refill inventories. When people experience unavailability firsthand, reassurance loses power. This is the moment when markets lose their ability to coordinate expectations. Participants no longer wait for confirmation. They act on observation, and observation says access is shrinking. Scarcity changes time preference. The future becomes less relevant than the present. When that shift occurs at scale, markets do not normalize. They reprice reality. At this stage, it becomes clear this is no longer a market cycle. It is a structural shift. Systems built on abstraction are colliding with a world governed by constraint. And when that happens, the rules change quietly, then all at once. For decades, value was defined by credibility. Currency worked because people believed it would. Assets were priced assuming liquidity, cooperation, and continuity. That framework held as long as trust remained intact. But trust is conditional. When conditions change, so does the meaning of value. What replaces it is not ideology, but necessity. In a constrained environment, usefulness outweighs yield. Assets are judged not by models, but by function. Can it be delivered? Can it be controlled without permission? Can it survive stress? These questions now matter more than projected returns. This is how monetary systems evolve in reality, not through announcements or reforms, but through behavior. Participants migrate toward what holds up under pressure. Those assets become anchors. Over time, everything else is priced in relation to them. Most people recognize this transition too late. They wait for confirmation, for official language, for a clear signal. But structural shifts do not announce themselves. They emerge through millions of rational decisions made independently, all pointing in the same direction. In this environment, paper representations lose influence, not because they vanish, but because they become optional. And in times of scarcity, optional claims are discounted. Tangibility carries weight. Control replaces convenience. This is why attempts to restore the old order fail. The incentives have changed. Participants are no longer optimizing within the system. They are positioning beyond it. This is not the end of markets, it is the end of assumptions. A new hierarchy of value is forming, shaped by limits, access, and resilience, and once that hierarchy takes hold, it does not reverse quietly. This is where perspective matters most. In every major transition, those focused on prediction fall behind those focused on positioning. The future does not reward perfect timing. It rewards preparation. What we have examined is not a single shock, but a recurring pattern. When systems drift too far from physical reality, they are eventually pulled back by it. The lesson is not fear, but respect for constraints. Paper systems expand easily because they are abstract. Physical systems do not. They require energy, labor, time, and resources that cannot be created on demand. When those limits reassert themselves, leverage collapses and simplicity regains value. Strategically, the takeaway is clarity. Separate exposure from ownership. Understand counterparty risk. Recognize that convenience often masks fragility. The most resilient positions are rarely the most efficient on paper. They are the ones that still function when assumptions fail. This is not about abandoning modern finance. It is about balance, liquidity,